Which weekly fund of funds ETFs is right for you? Is it the YieldMax YMAX? Is it the Roundhill WPAY? Is it the GraniteShares new funds that they've introduced? Which one fits exactly you? We'll find out today. Hey everyone, welcome back to the channel. I'm Doug, the Retirement Guy, and that's right. What we're doing today is continuing our series of Right for You. Which fund is right for you? And today we're going to go deeper dive into the weekly fund of funds. And that's going to be the YMAX, the WPAY, and then the new ones from GraniteShares. We're going to dive deeper into these to figure out which fund, if any, are perfect and working well for you. Let's get into today's video, and we got to do a shout out to all of our Patreon supporters. You guys are phenomenal. You continuously add. A lot of people joining on the free package. Some are even supporting the channel. We appreciate each and every one of you. Welcome back. And all of our subscribers, welcome back to the channel. And if you're not a subscriber, don't be afraid. Hit that bell notification. Hit that subscribe button. You don't want to miss a single one of our videos. Let's get into today's video. The truth about weekly income ETFs that most investors see these ETFs as one thing and one thing only: weekly income, giant yields, and a simple choice. Well, in reality, these four ETFs are not the same product, and they all wear different labels. The YieldMax YMAX is a diversified YieldMax fund. It's got a broad exposure and a moderate risk. WPAY out of Roundhill is a multi-issuer approach. Issuer is diversification, and it does have that moderate risk. Now, GraniteShares introduced two new funds, and that is YBST, which is the YieldBoost Focus, which takes all their YieldBoost items and focuses into one sector. It's a high yield strategy, and it has some very high risk to it. And then they introduced one that I thought was going to be very interesting across the board, and that is the YBTY. And that is the GraniteShares, basically YieldBoost Yield Fund, which gathers all the top yield concentration of their YieldBoost funds into one to maximize the yield focus. And I'm going to put it here, it's a very high risk because I've said on the channel many times, chasing yield does not win. There is no best weekly fund of funds ETF. The only right one for the right investor is to use the right allocation. Let's put it right out there first. I'm not going to be giving you a winner. I'm not going to give you any losers. I'm not going to give you anything of it because this is not financial advice. What I'm going to show to you is the true hardcore facts of each and every fund to see which one will fit you and maybe not. So really, let's start off with what is a fund of funds ETF? And the definition is a fund of fund ETFs does not hold individual stocks, but instead invests in a basket of ETFs, creating a layered investment structure. These came out originally from YieldMax when they said we're going to invest in ourselves, and they're going to buy every one of the weekly pays and put it into their YMAX package. So the key characteristics of it is combining multiple strategies and risks. They're going to give you multiple expense ratios, and they're going to create a diversified exposure through the underlying ETFs. So you get a lot of these that are the individual stocks in the ETFs. They're going to put them all into the underlying ETF, which then comes into and falls into the fund of funds. So the key implications of a fund of fund structure is a fund of fund ETFs invest in a basket of other ETFs, creating that layered investment structure that combines multiple strategies and multiple risk profiles. Now, the fund of funds is from the portfolio manager and distribution mechanisms, underlying ETFs, and then the individual holdings. So the risk exposure, the investors are exposed to both the underlying ETF's risk and the fund of funds' own management decisions. The fee structure, multiple layers of fees can erode returns with gross expenditures around 1.28, with the net expense around 0.99, like WPAY. The income is generated by option premiums distributed from underlying ETFs and compounded effects. Okay, so what they're doing is what income is coming from the underlying ETFs is gathered up and put into it to pay you. So it really is like you're buying one fund to get 10 funds, 10, 15 funds of all these weekly pays, putting them in one basket, and then getting the refunds from that. So let's start off first with the number one that came out, which was YMAX. And this is what they classify as the deferred YieldMax exposure. So how did this fund really come about? But YMAX is the fund of funds that holds multiple YieldMax single stock option ETFs. Now this one rebalances every month to equal weights. So what's going to happen is one particular fund or two funds take off and do very, very well. They're going to rebalance everything at the end of the month. They're going to rebalance everything back to basically about a 5% level across the board. Now you can see over here, I put on here, the equal weight structure is that they're putting 25% into tech, 25% into consumer, 25% they call their growth, and 25% of other. So they're spreading it out across the board. This gives you a diversified, broad exposure across multiple YieldMax ETFs. And with that equally weight, there's no one fund that will really take off. So the income focus is designed to give you that potential of a consistent weekly income, but never guaranteed. Remember that. Dividends are never guaranteed in any fund that you purchase. So it is actively managed by YieldMax, and it seeks to generate that income. Now, let's take a look a little bit under the hood, and then we're going to pop the hood completely. And this is going to be the YieldMax income generation performance. So the income generation, remember, invest in the YieldMax single option income ETFs. And they got so many different ones. This is like buying one fund that has them all. It sells those covered calls or credit spreads on those single stocks, and the premiums flow upward to YMAX for the weekly distribution. And again, rebalancing it monthly for the equal weight. So far, the distribution rate looks phenomenal at 76.58%. The 30-day SEC yield is at 41.82%. Now, all of these are from January 13th when we pulled the information. Now, over the last 3 months, the NAV loss has been about 8%. Okay, and the market price change is down 1.69%. But since inception, this fund has lost over 25.56%. Now, people will sit down and say NAV erosion, and in some cases, they're actually right. Now, the distribution is high enough to try to cover some of that. So if you're not doing a drip, if you're not doing reinvesting into it, your actual assets are going down, but you're getting big income. The distribution breakdown, well, this is another unique piece. Regular income, 34.88% of the distributions come as regular income. 41.7% come as return of capital. Now you'll look at everything and they'll say return of capital is used for tax investment purposes because they're kicking the can down the road. And then on the other 23.42% is really coming back into his other sides of their distribution. So now let's pop that hood, look really hard into this one and say what is actually going on. So YMAX basically over 1 year has lost 39.65% NAV growth. So it's down. And when this fund first opened up, January 16th of 2024, you're looking at this now as we're here in the 26, 2 years old already. It started off about $16.50. It's down to $10.06. One of the problems that you run into is all of these funds are doing covered calls, so it has a hard time raising its value back up. When you seen that April 2nd drop off, it slowly came back up and then maintained it for a little bit and then slowly again has dropped off. And I would say the market adjustments are more larger with these guys, that they can't recover as quickly. But we also know, and people will call it NAV erosion, because it has dropped off from February all the way out to January. It has had pretty much a downward trend with some flat spots throughout. Now, the assets, $635 million in net assets. They have an expense ratio of 1.28%, over 62 million shares outstanding. The dividend, they've paid out $7.59 over the past 12 months. That gives it a 75.47% total yield. So it pays out that weekly expenses. You look down below, distribution rate, 76.58 is the actual hardcore over the past 12 months, because the chart above is actually buying into a little bit into January. The NAV growth is down 39.65% again since January 13th. Your total return rate since inception is 17.39%. Over the past year, it's only been 8.34%. So the fund has not really developed that 76% distribution. You got to take a look at this as seriously and say, am I really getting 76%? And the answer is no. You're actually only getting a total return of 8.34% over the 1 year and 17.39% since inception, so which is about 2 years. So it's really a fund that you really have to pay attention to. Now let's talk about WPAY. This one comes out of the Roundhill. This is a multi-user diversified strategy. Now, when this thing came out, there was a huge hype about this one coming into play. Everyone thought this was going to be the game of all games. And what WPAY did is a passive managed ETF tracking the Roundhill WeeklyPay ETFs. It's a universal index designed to invest in a broad universe of single stock weekly pays. So when you take a look at the big pie chart that you see up here, you see they have a mixture of everybody on their weekly pays. We got the Google up there, the Amazons, the AMDs, and here's the thing that gets it. They rebalance this one as well. This one gets rebalanced every month, and that's why you can see most of the funds are in that. Basically, they call it an average of 5. It's about a 5% per fund. Now, some funds have a little bit more, some funds have a little bit less, but overall, the cross board is a balanced approach at 5%. Now, the spread exposure across the multi-ETF issuers reduced the reliance on a single manager's execution. That's why we call this a passive managed ETF. They do not have a single manager making all the decisions. They're doing more rule-based investments. So the investment in the ETF is using covered calls, option income, and other weekly distribution models throughout all the different funds. Now the net layer fees is 0.99%. The gross is 1.28%. So the full holding is not always disclosed. So they don't have the full, I call it the full transparency, that they don't show everything that they have either money invested into or what they hold money on. Because these guys use a lot of funds in the rears to hold into treasury bonds or into put calls or any type of cover call that they may use across the board. Now, WPAY risk profile in the best use cases. This is a moderate risk with layered fees, ideal for investors that are diversifying over maximum yield. The risk level is moderate. We've done many videos on WPAY. We've really watched this one very carefully because of all the hype that was out there. The best case uses is a diversification focus. Investors seeking broad exposure across multiple ETF strategies. that are still looking for that weekly income, because the potential of consistent weekly distributions from this income-orientated investors is what this fund really is designed for. So this is more of a balanced approach to income and a balanced approach to risk, because they're spreading it across multiple, I believe it's like 20 or 25 different funds that they're spreading it over. Now, when we pop the hood on this one, this thing was doing good from its inception of September. It was actually September 4th of 2025. It was doing fairly well. People were very pleased with it. It came out at that $50 price point, raised all the way up to a $56 price point, which was $56.50 was its highest price ever. And then it slowly has dropped back down to that $41.70 mark. It's down 17.83% over the past since September. So it is really what I call, it's not really NAV erosion, but it's really balancing itself into where it belongs into a fund. Roundhill always does this. They start their funds up at about $50 for every fund. And then they allow the fun and the excitement and everything to settle itself down to a number. And then it just kind of coasts along across the board. We look at the performance so far. And it's kind of throws things a little bit. Year to date, 2.11%. And that's going to be your total return. And the reason why I say that is this is your basically your dividends and your growth all combined into one to give you a total return of 2.11%. Since inception, only 2.05. Now, I'm going to be very clear. Like I said, this came out September. So we got October, November, December. So we're just a little basically into 4 months into the fund. Distributions, 23.32%. So we're not blowing out some big numbers. But I will say that they've paid out $9.72. So their distributions have been bigger. But the price of the fund definitely has been higher. And that's why you see a difference in those dividend yields, which is why we always say you can't chase yield. You have to chase total returns. The NAV growth right now is down negative 17.83% for that total since inception total return of 2.05%. So even though they are paying out some big distributions and you're getting some good money, you're not getting a total return out of WPAY. Now we're going to get into something unique, and this is going to be the GraniteShares side of it. The GraniteShares is YBST. This is what they stepped up to get into the Fund of Funds program. Now these funds are very new. Okay, so we're not going to have a lot of history onto these things, but GraniteShares has struggled in the past 60 days easily. But YBST, it invests in the GraniteShares YieldBoost ETFs. And if you're not familiar with YieldBoost, these are ones that basically are using 2 times leverage in their weekly paying ETFs to try to boost the growth. And the problem with leverage, as we all know, is it works great in the upswings. It works horrible in the downswings because it goes down twice as much. So it focuses on high yield YieldBoost ETFs. It uses put spread strategy on leveraged ETFs. That was a unique thing that I did my research on, is that I found that they're using puts, which means they're selling the losses. They're selling at the negatives. And they're trying to capture the high option premiums. They're looking to maximize the yield at the cost of increased volatility. So the put spread strategy and visualization that we're showing you here, and what they're saying is they're trying to sell you a fund that they know is going to have a downward trend, and they're trying to sell you that so you can buy something later on, and hopefully it never gets to that level. So we call it the credit side. It's the near the money put options, and the debt side is the further out the money puts, that you're buying them further out. The income mechanism, the premium income from selling those puts, is put into the fund. Higher premiums on leveraged ETFs and weekly cash payout potential for the shareholders. When we take a look at what they've done, Very similar combination of the past two funds. You look at this one, they're using about a 5.5 to 6% range across the board on all of their GraniteShares weekly funds. So it elevates the NAV volatility. It gives you the downside exposure because those put spreads limit the losses, but they don't eliminate them completely. And the income stability, the high yields are not guaranteed. This is best suited for an advanced income investor, deep option understanding, technical income strategies, and I put it very high risk on these things because of that leverage that you're playing with. So when we popped the hood on this one, like I said, this came out December 16th of 2025. So realistically, as I'm doing the recording today, this is actually 1 month old. They have $3.26 million in assets and a 1.38% expense ratio. It's paid out $1.49 in dividends, which is basically about a 6.46% in distribution. Now, here's the other one. Since at the day of taking this, because these numbers will change. I'm telling you right now, these numbers will always change. Every video that I show you, the numbers will change as I'm recording it, strictly because the market's open and doing what it's doing. But so far, over the past 30 days, it's down 8.24%. It's settling into a number that it can establish and hold. But you can see in January, it's been going down very slightly. The distributions, your average, those are coming down because of the volatility. It's 35.8 cents. It's paid out the last dividend. Total return using stock analysis came back with a total return on January 13th of 2.55% total return. So this one, again, so much little information. You get $1.49 of annual distributions. What I don't care for is the downward trend already of this one. If you've watched the channel before, I always tell you the same thing. You have to wait 6 months before you buy into a fund because you want to see what happens. Does it settle down? Where does it go? How's it going? And then establish yourself where it needs to be. So this fund of funds, again, how everything pulled together, we don't have enough data to say if it's good, bad, or ugly. All we can say is that, yep, it's settling down to a lower number. The 22.98 is the lowest it's possibly ever been. So we're only a few cents above that number. So are we at the bottom? Looks potentially that we are. But like I said, I'm not an investor of this. I don't own any of this. I'm watching it as you are. Now, this is the fund that originally, when it first came out, I was excited about. I thought this would probably be right up a lot of people's alley, especially my alley. And this is the YBT top yield concentration approach. What they did, instead of just pulling all of their yield-based funds together, these guys sat down and said, we're going to do something different. We're going to do a strategy focus. They're going to take the highest yielding funds from the YieldBoost universe, and they're going to put them all together and concentrate exposure to those top performing ETFs. They're going to prioritize cash flow above all else. So they're not looking for growth. They're looking for positive cash flow across the board. So the features of it gives you potentially higher yields. It gives you that weekly income focus. And it's a simpler basket because you're really only getting about 5 different funds. Now, unfortunately, the risk to it is less diversification. So with only having 5 funds, you're very little diversification. You're more sensitive to market swings and a higher chance of income volatility. The benefits, higher potential income, the higher potential weekly cash flow, and a simpler strategy to understand. So the 5 funds that they're using right now is TSYY, COYY, HOYY, IOYY, and SMYY. So virtually equally apart all the way across, which equals out to be about 20% across the board on those funds. Popping the hood on this one came out December 16th. So again, we're about 30 days old with this one. It's down 10.56%. The distributions are a little bit lighter onto it. So their distribution rate is 7.78% with paying out $1.75. So a little bit higher than what its counterpart has done, but more NAV loss than before. The total return 2.9. So again, not a lot of information to build it off of. It's slowly building those numbers. But I was impressed that it had a little bit larger assets of 4.33 million, expense ratio 1.38. So this one here, again, needs time. It needs time to grow. Those 5 funds, if you look at them individually, as I have, because I actually own the majority of those funds, it fits right in line with about a 10% drop off. They're about 11 together combined. They're about a 10% drop off across the board. So YBT's risk, again, it's a high risk factor. It's a very high risk because extreme sensitivity to market volatility, income volatility, the likelihood of the income fluctuations. You're not going to get the same amount each and every week. And it's a concentrated risk because you've reduced it way down. It's great for income only focused investors. If you don't care about your assets, if you don't care about long-term pieces of it, you just want income, it's a fund to be looking at. Active monitoring is definitely a must. Those who track those positions daily, you want to be a part of this. And you got to have a lot of risk tolerances when you're dealing with this type of a fund. So when we take the funds and put them side by side comparison, across the board, YMAX being the oldest one out there, has the moderate high risk level. The yield focus is extremely high, and it has a core income sleeve. The WPAY is a multi-issuer weekly income. It has that moderate risk, so it's a little, I don't want to say safe. I can't use the word safe in this thing. What I want to say, it's just a moderate to the risk. So it's the least one with the risk level. It's a moderate high focus on yield. So it's like trying to be a balanced thing right in the middle, and it's a diversified weekly income. The YieldBoost from GraniteShares, the universal fund of funds, extremely high risk. It's very high focused on income, and primarily because of those leverages that are part of it. And it's a tactical income strategy that they use. And then the yield, the YBTY is the top yield concentration from YieldBoost. This one is extremely high because you got all your eggs in basically 5 baskets. It's extremely focused on yield. That's what we said earlier, cash flow. And honestly, I think it's for short-term income only people. I got a short period of time, want to generate so much money, you want to generate, get in, get out, and be done. So across the board, real quick here, we'll give you the framework for an investor, and that is YMAX is that, again, that moderate high, WPAY at the moderate, and then the yield boosts are all high or higher risk. Income needs, again, focus. YMAX focuses onto it. WPAY is trying to give you both the growth and income. And then both the yield boost packages are both looking for high yields. So realistically, where do we put it? Well, the question is, what kind of an investor are you? What do you want? Where do you want to be? So I can tell you some of the risk considerations of these funds. 1, NAV erosion risk. Everything we deal with weekly ETFs, we have to talk about NAV risk. The option of decaying the NAV just causes the big NAV decline. And the frequency of using the return of capital, we all know that's a positive for tax purposes, but you got to keep a close eye on those assets under management. If you see those things fluctuate, you know they're taking money out of the pocket to pay you those distributions, and it's not good. YMAX uses about 41.70% over 2025, so you can see their numbers are definitely the heavily use of ROC. Most of these things are market dependency, require stable or risk markets. And we haven't had that lately. And the market downturns is going to affect the NAV and the volatility is what's going to give you your price changes. So for the beginners, it's really, I call unsuitable, because you have to understand the option knowledge. You have to know about capital preservation, because there really is none in these groups. And it's a high learning curve that people will actually put money in and lose money because they don't understand the capital preserve of the package. Guys, so important notice to everybody, this presentation was designed and provided to you by an educational purposes only, and it's not constituted financial advice. Educational purpose, no financial advice. Distributions are not guaranteed. The yields are subject to change without notice. And if you need any professional help, if you need questions on the financial stuff, always contact a financial professional. Don't just watch a YouTube video. Don't just ask someone who sounds like they're intelligent with it. Always ask a professional first. My final investment guide of all this, these are income engines, not growth vehicles. Do not expect to put your money into these and expect to get a growth across the board. At best, you're going to hold your own money. The investor profile matching, choose which one fits your risk tolerances. Match your income needs to the strategies. Allocation and strategies, use the income sleeves. These are not core profiles. I personally hold these in a totally separate portfolio away from my core portfolio. It's like no more than 5% of my old total portfolio is set up for these type of funds. Understand the mechanics, and if you understand that, you're going to understand which one will fit best for you. As I said, there is no best weekly fund of funds. That's only the right one for the right investor to make it work. Guys, I appreciate your time. I appreciate you watching the video. If you like it, give us a like button. Hit that like button. It helps the channel tremendously. If you're not a member, hit that subscribe button. And we thank you for watching, and we'll catch you back. Leave any comments down below. Love to hear what you guys have to say about these funds.